Hi guys, yesterday we did business valuation up till price to earnings ratio. Yeah, the formula was PE ratio is equals to market price per share over EPS, where market price per share was computed using PE ratio of sector average into EPS. But now today we are doing earnings yield method. Earnings yield method has a formula of EPS over market price per share, just the opposite of PE ratio. And in order to compute the market price per share, you need to calculate it using EPS over earnings yield percentage. Okay. Um, then you have the free cash flow method, which we'll be doing looking at later. And then we have market capitalization method, where the share price per share into number of shares would give you the total value of the company. Previously we did up till PE ratio, yeah. Now you need to perform this question 5, that is the earning yields question. I do not think it is tough, which is why I am asking you to perform it. Then we have this NN company question. Even if you do not perform the example, that is fine, but please make sure you do perform this NN company question. They have given you the balance sheet and it says NN company has just paid a dividend of 66 cents per share and has a cost of equity of 12%. The dividends of the company have grown in recent years by an average rate of 3% per year. The ordinary shares of the company have a par value of 50 cents per share and ex-dividend market price of $8.3 per share. The long-term borrowings of NN Company consist of 7% bonds that are redeemable in 6 years' time. At their par value $100 per bond, the current ex-interest market price of bonds is 103.5. The preference shares of NN Company have a nominal value of 50 cents per share and pay an annual dividend at 8%. The ex-dividend market price or market value of the preference shares is 67 cents per share. NN Company pay profit after tax at an annual rate of 25% per year. Now you need to compute the value of NN Company using DVM method and using the net asset valuation method. Okay. Once you have done that, you must compute the after tax cost of debt of NN Company. You must calculate the WACC of NN Company, and that would be all. After NN Company, you will be performing this question, this KFP company. Um, in this also you have to use price to earnings ratio method and DVM method to compute the value of your share, and you have already computed back of it. Um, so you can leave the first part, but make sure you do compute answers for part B. You will then be computing the answer of THP company. There is no new method in this. You have done sources of finance, so you can also compute the TERP, and without the TERP you cannot compute the market capitalization. So do complete part B and part A and part C. The theory of efficient market hypothesis is given um, right at the end of the document. Now let's look at the free cash flow method. This is the format and the formula of the free cash flow method. First you need to compute the FCF. Once you've computed the FCF, then you will compute the value using the formula written above, that is FCF 1 plus FCF into 1 plus G divided by WACC minus G, where G is the growth rate and FCF is the free cash flow value of the company. This is the question you will be performing for FCF method. These are cost of goods sold and these are not CUS, these are CGS. Okay, you will also be performing this focus company question. All you need to perform in this question is the requirement A, price to earnings ratio method, and dividend growth model. But if you look at the part B of the question, it says market value needs to be computed, floor value needs to be computed, and conversion premium needs to be computed. And that I am telling you how to compute um, on the notebook. So you can copy it, and I am explaining it to you as well. In the focus company question, redemption will be done in this manner, and once you have done the redemption and the conversion, you have computed the present value using the redemption and conversion both, then you will assign the floor value and the market value of all bonds. The higher value out of the two is the market value, always. Whenever such a question comes, you must compute redemption and conversion both, and the lower value is the floor value. So we have computed the market value, or we have computed the floor value. Now we need to compute the conversion premium. And the conversion premium is the difference between the outflow of company if bonds are immediately converted into ordinary shares, that is 20 shares into $4.45, that is $89, and outflow of company if bonds are converted into ordinary shares at maturity, expressed in present value terms, that is 123.8, right? So the difference of $234.8 is the conversion premium. I hope you guys won't have any confusion now in performing the question. And before you move on, just in case, if uh, the value of private unlisted companies is given, sorry, has to be computed. So in that case, the PE ratio of private companies is believed to be 2 over 3, or 50% of the listed company. So the cost of equity will be higher than listed company. Example is Forbes company is considering to acquire Denoka company. Forbes company is listed and Denoka company is not listed and is in the same sector. So the value of Denoka using price to earning ratio would be computed now through the average sector ratio, that is going to be 6.67 times into zero point 0.4. That would give us $13.3 as the value. In the previous question, that is in the original question, you did not have to compute the value in case of this being a private company or an unlisted company. All you had to do was to compute the price to earnings ratio. So to compute the market price per share using the price to earnings ratio, considering the company as a listed one. So now that you have to consider it as a unlisted company, what you do, the price to earnings ratio of sector average was 10 in the question. You will reduce it to 2 over 3. This is going to give you 6.666 times. So I have rounded it off to 6.67 times. Okay. The cost of equity, however, is going to increase. As it says, cost of equity will be higher than listed company. So it is going to increase to 15% from 13%. Next we have is the EMH. Factors in valuation of shares, fundamental analysis, technical analysis, and random walk theory. In fundamental analysis, the share price is predicted through the fundamentals of the company in order to compute some uh, important calculations for the future. For example, future dividends. People predict this approach uh, are called fundamental analysts. In technical analysis, share price is predicted through past prices. People predicting share price through this approach are called technical analysts or chartists. And in random walk theory, share price is predicted by considering that share prices are believed to follow a random walk and will immediately update as soon as new information becomes available. So the efficient market hypothesis is when the share prices immediately react to all the information that is available, and efficient markets are where prices are true and fair and are always updated. However, inefficient markets are where prices are not true and fair and are not updated. After completing the Forbes question, you have to do QSX and the correct company. If you guys have any queries in any of them, please WhatsApp me and I'll explain it to you. But do complete these questions because these are very straightforward questions, and let me know then. We are done with the business valuation chapter. Copy the advantages, disadvantages that I am posting on the classroom of each of the methods. Take care. Bye bye.